Good afternoon, everyone, and a warm welcome to all joining our webinar on Navigating Volatility, Strategies for Success in Today's Financial Market. I'm Aakanksha Shukla, your host for the event. I'm heading Products Desk at Mastertrust. Thank you for joining us on StreetXperts today for an interactive afternoon with our expert speaker, where we will understand the Indian market's current placement and discuss some of the most talked about factors, their impact, and strategies to navigate through them. But before we commence with our agenda, let me take you through a brief introduction of Mastertrust, who we are and what we do. I hope my screen is audible to everybody. Mastertrust is one of the leading brokers in Indian market with presence in 22 states. With 39 years of professional services, it offers opportunity in wide range of asset classes. With a total customer base of 3,80,000 plus and customer assets of close to 34,000 crores, Mastertrust is thriving and expanding at a rapid pace. Mastertrust Limited, which is our group company, is a listed entity. We run our trading business under Master Capital Services Limited and our PMS operations under Master Portfolio Services Limited. Our insurance business is taken care by Master Insurance Broker Limited. And our range of services offer from algo trading solutions, equity trading, derivatives trading, currency trading, commodities trading, research and advisory, wealth management, depository, insurance, and merchant banking. As we mark 39 years of Mastertrust's legacy, this journey has been truly remarkable. We have thrived and remained resilient in our ever-evolving industry, witnessing substantial growth as a company. With vision to be a well-diversified financial services provider for wealth creation, Mastertrust has built a unified platform that caters to all kinds of investment needs, offering investors and traders the best user interface and experience nationwide. With that, let's start today's discussion. I would request active engagement. Please feel free to drop in your questions in a Q&A section, which will be taken up at the end. Thank you once again, and let's make today's webinar enriching for all. With that, I will quickly introduce our expert speaker for the day, Mr. Gautam Shah, founder, Goldilocks Premium Research. He's a well-known financial market veteran with over 2 decades of experience. Goldilocks Premium Research is the only Indian research firm to be awarded thrice consecutively at the prestigious Global Technical Analyst Awards declared in London. Gautam Shah is also one of the few Indians to hold all 3 global certificates in the field of financial market analysis. He's a chartered market technician, certified financial technician, and member society of Technical Analysts London. He's a popular face on the visual media, having done over 700 interviews with business channels like CNBC TV 18, NDTV Profit, ET Now, Z Business, to name a few. His research work is followed closely by the biggest of the market participants around the globe. I extend my warm welcome to Gautam once again.
Hi, Aakanksha. Thank you so much to you and the entire Mastertrust team.
Thank you. Gautam, in the dynamic world of finance, where every decision counts, understanding the nuances of the current Indian market is not just advantageous, but essential. The speaker will dwell into current trends and strategies for successfully navigating through the action-packed Indian markets. So let's know from Mr. Shah today, what's his strategy for successfully navigating volatility that we are witnessing in Indian markets currently. Without further delay, I would like to initiate the discussion with the first question. Gautam, I think this is one of the questions which is most prominent in the Indian markets as of now. So what is your outlook for the Indian markets? What's your short-term and long-term outlook for Indian market?
Well, yes, thank you for having me. I think everybody is obviously wanting to know the market outlook, given the fact that you have the election results in a couple of weeks from now. Honestly, I think if you look at the last 10 years, since the last financial crisis in 2008, in fact, since then, you've had a scenario wherein the markets have consistently made a series of higher tops and higher bottoms. So what I'm trying to tell here is give you a perspective that since 2009, if you bought the market on any dip, you would have made money. And this is the case for the last 14 years. I know people talk about the COVID period, but remember the COVID period was just about 4 to 6 weeks and the market stabilized thereafter. So I think from a longer term perspective, we remain in a very strong upward trajectory. And this has been the case for the last decade. And I don't think there's anything different right now. We remain in an uptrend. I think the liquidity factor is extremely strong because it just tells you that this domestic liquidity has changed the game completely. There is very limited volatility. And every time you've seen a market dip in the last 4 to 6 months, we've always come back. I mean, look at the last 4 months. There have been dips of 1,000 points on the Nifty. It scares a lot of market participants, and then it keeps coming back every single time. So clearly, this liquidity factor is protecting this market, something that we did not see a decade back or decade and a half back. So I think that for me is a game changer. India's fundamentals are all up there. India's outperformance in the world is up there. India's demographic positives are all there. So, all of those positives are always there, but the liquidity angle has changed the game. I do believe that we are in a sort of a consolidation phase from a near term perspective. And with what markets have done last week and particularly today, I think the chances of the Nifty going back to the recent highs of 22,800 and beyond are pretty high. Now, you might ask me that, can you give me a fancy target on the upside? I'm not a firm believer in targets because I think it's important to stay in the bus than to know the destination. As Rakesh ji, the late Rakesh ji used to famously say that the idea is to just participate in the market without knowing how high or how far it's going to be. So I think the trend is up, the trajectory is up. There are immense opportunities. And on the downside, I think for any investor, 21,500 to 21,800 is the line in the sand. Till the market is above that, do not overanalyze, just participate. I think there could be a time over the next 12 to 18 months that the index could deliver 15 to 20%. But just lower your expectations. I think gone are the days where you can expect a very large move on a daily basis or on a weekly basis because a lot of the positives are factored in, but the overall trend is definitely positive.
So, apart from the trend, that's a positive outlook, and that's again contributing to what I think all market veterans are thinking currently, that India is a positive story in the upcoming decade, except for some hitches that might happen in the short term. What about some key factors that you feel will be influencing the market, is influencing the market, and any anticipated shift?
See, I think the one key factor right now, which everybody is talking about, is elections. And if you look at the last, I came into the market in 2003. So I've seen 4 elections in these last 20 years. And I've seen that elections have been a game changer. I remember 2004, the market was lower freeze post the election verdict. And 2009, the market was upper freeze post the election verdict. So that's the kind of trends that we've seen around elections in the last 20 years. But 14 and 19, 14 I thought was a game changer. 2019 I thought was a non-event. And even now, this looks like a non-event election in some sense. So the market is concerned about the election, but I don't think that's too much of a factor. The only factor, honestly, the way I see it, is geopolitics. I think the world has changed completely. We've had so many of these smaller battles and wars, on the global financial markets and between various countries in the last 1 year. It's quite amazing. And despite that, you have India and world equity markets super solid. So I think my key risk is in this world where pretty much everybody is trying to fight with everybody. I think that's a key financial market risk, the way I see it. Everything else, I think, is earnings driven. And from that perspective, I think we have clarity at least over the next 2 to 3 years. And once the election event is out of the way, I think the market will be free in its mind that over the next 5 years, I have some clarity what's happening at the top. And let's just go back to liquidity, fundamentals, and India's positives. So geopolitics, according to me, is really the key risk that I see. Not even oil, not even rupee, not even the fact that liquidity will suddenly slow down. I don't think all of that will happen because this liquidity thing has happened after 2 decades of trying to push domestic liquidity and which has happened beautifully.
Correct. In fact, as we go ahead with the discussion, geopolitical is something that I would like to really throw some light on, and would like to have your views on that. Thank you, Gautam, for this. Moving on to my next question, which sectors do you think will be the potential outperforming sectors post our general elections? Since we were on the general elections topic.
Yeah, so I think it's been a very interesting scenario. I always like to take a step back to understand the future. So if you look at the last 3 years since 2020, when we bottomed out at 7,500 on the Nifty, you know, there has always been one sector or one pocket in the market which has grossly outperformed. It started with IT, then it moved to real estate, then capital goods. And now the way I see the price action of the last 4 months, I think the new mega trend in the markets is metals. Now you might say fundamentally, what's so positive about the sector that you're so bullish? As a technician, I think what we have seen in the last 2 3 months is that on the ratio charts, which we follow very closely at Goldilocks, we have seen a massive breakout, something that I saw on the auto sector a couple of years back. So I do believe what auto has done in the last year and a half, metals could do that in the next 1.5 years. And I think the fundamentals thesis will also pick up. The China recovery is also a very important factor. So if there are three sectors which I would want to recommend to your audience today, that would be metals, that would be pharma and FMCG. I think FMCG is coming back after almost 6 months of underperformance. Our views don't change. So if you heard me on business TV at any point of time in the last 2.5 months, I would have maintained the same stance. So these three I feel will generate alpha, and you need to allocate a sizable value to your portfolio in these three pockets. Let me also add that precious metals, gold and silver, is also a sector, also a theme. Because everybody talks about equities on a day-to-day basis. Remember, this year so far, gold and silver has beaten equity market benchmark returns. And I think this is going to continue going forward. You have silver at a level of $30 internationally, gold at a level of 2,400. So my key point here is, along with equity market exposure in the sectors which I spoke about, also look at exposure to gold and silver. Let it be sizable. Let it be 10 to 15% of your portfolio, because I think the real return will come from those two asset classes over the next 12 to 18 months.
And the sectors that you mentioned, what is the potential risk or challenge that you expect in these sectors despite the election results, indifferent of that?
See, election results is 2 weeks away. So I think post June 4th, nobody is going to remember what really happened on that day. I mean, that's what I have seen in the earlier periods. The market goes back to business, goes back to looking at the usual traditional, parameters. In terms of key risks, I think metals as a sector is known to be cyclical in nature. So there are certain stocks which are major beneficiaries to what's happening globally in commodities. I mean, look at copper, look at aluminum, look at a stock like Hindustan Zinc or a Hindustan Copper. With what has happened. So the key risk is volatility in international markets on the commodity side. So that, from a metals perspective, that's the key risk. In FMCG, the key risk is many of these stocks are very expensive, right? So you can't just go out and buy anything and everything. But then if you speak about ITC, a stock which is really not expensive, until some time back, it had a great dividend yield. There is a much smaller risk in those stocks. So in some sense, at a 22,500 Nifty, you need to be in low beta and not in high beta. In the last 3 years, high beta as a strategy worked well because the market was running away. Every day was a good day. Every week was a good week. Not the case anymore. You speak to any trader on the street in the last 4 months, and he must be absolutely frustrated because the Nifty goes up and down like a pendulum, but there is no real trend. So there are some risks around valuation. That I think that's one key risk for many stocks and sectors in the market. Barring that, geopolitics can also play a very important role to the global dynamics. The China factor, the Russia factor, what's happening in the US, elections in the US. These are also factors that we need to keep a close eye on at all times.
Absolutely right, Mr. Shah. Actually, that brings me to my next question, that what do you see as the major trends in the global market? Because as you rightly said there, that geopolitical is not the only risk, but there are other factors as well. So please throw some light on what are the other trends that you see in the global market, the major ones.
See, I think the world has changed quite a bit in these last 20 years. And I think every morning when I get up, the first thing is when I look at some social media posts, I just ensure that there's nothing wrong that has happened anywhere in the world. Because of that, you could have the Nifty open with a big gap on the downside. So I think geopolitics plays a very important role with what markets have done. And I think that's really the key risk that we work. I'm sorry,
And
again.
yes,
Which
I
one?
asked about the other factors. So apart from geopolitical risk, what other factors do you think will be the major trends, like the China plus one? But again, China and Hong Kong is picking up. So please, if you can throw some light on that.
Yeah, as we speak, you have a very interesting scenario because US markets are at lifetime highs,
Yeah.
European markets are at lifetime highs, Indian markets are close to lifetime highs, China and Hong Kong is at a multi-month high. So you actually have a global bull market going right now. And in that bull market, India has been an outperformer. In terms of key trends, I think what you could see in the later half of the year is that the Fed starts cutting rates. And if that were to happen, then that's obviously going to have a cascading effect to everything that's happening in the world. And I think that's one key positive, which the market is now starting to discount. And you got the inflation numbers a couple of days back in the US, which were not too hot, and therefore the market was excited. The Dow hit 40,000. So one key trend is, if the rates were to come off, which will come off over the next 4 to 6 months, play on those sectors which will be beneficiaries. And the second big trend, as I see, and I want to repeat myself because I think it's a big opportunity, it is gold and silver. Because we live in a very dynamic world where anything happens anywhere in the world, gold is up the next day, silver is up the next day. And these are two precious metals which are coming out of multi years of consolidation. So I do expect gold to eventually hit a level of $3,000 and silver to maybe appreciate to levels of 36, $37, which is 20, 25, 30% upside, which I don't see for the Nifty anytime soon. I mean, 12 to 18 months, 24 months, I don't see that happening.
So, will gold be a tactical call for you, where you can see exits in 12 to 18 months, or you take it as a strategic part of the portfolio, strategic call of the portfolio?
That's a very good question, because this is something that we discuss a lot with our clients as well. You need to have a structural portfolio, you need to have a seasonal or a tactical portfolio. According to me, gold for a number of years was a tactical play. Now it's become a structural play. So earlier we used to have people allocating 5% very conservatively, to allocation to gold and silver. Now we recommend people to take it up to at least 15%. So this is more like a structural play given all the positives. And we've seen in the last 20 years, my team of analysts put this data out all the time. Then in a period of low interest rates, and when the interest rates are down, gold tends to do really well. That's been the track record. Whether it happens or not, again, I'm not sure, but that's been the track record. So gold and silver, according to me, are more like a structural play, and equity markets and sectors are more seasonal, because you need to watch stocks and sectors every 3 months. There is disruption every 3 months. Look at Bajaj Finance, look at HDFC, look at Asian Paints. Three of the best companies, no doubts on fundamentals, no questions on fundamentals, but the worst performers among the large caps in the last 2 years. Right? So they are actually tactical, which people say is structural for the next decade.
True, absolutely correct. Before we move further, I would request the audience to please write their questions in the Q&A section, because we will be taking up the questions towards the end. So people who have been raising hands would request to please write your questions down in the Q&A section. Moving on let's shift the gears to the technical aspects of things. Would love to understand how to select sectors and stocks using relative strength as one of the key factors.
Yeah, this is something that we extensively use in our research at Goldilocks, which is relative strength analysis. Everybody talks about RSI. Here we are talking of RSC, which is relative strength comparative, where basically you compare one entity with the other to understand which is a better entity or a asset class to invest in. Just as an example, if I were to do a comparison between HDFC Bank and ICICI Bank. So what will I do? I will divide the share price of HDFC Bank by ICICI Bank. When I divide that, I will get a ratio. And that ratio is a moving number on a daily basis. If that ratio is going down, it means HDFC Bank is underperforming ICICI Bank, and vice versa. In fact, this is like a homework to your audience. If you can pick up any chart on any platform, please do this. HDFC Bank versus ICICI Bank, and you'll be amazed in the last 3 years, this trend has been on the downside. So as a technician, I have been committed and I've been advising my clients to be committed into ICICI and not HDFC, which obviously has done very well for us. So relative strength analysis is probably the only way in technical analysis to catch trends early and to catch trends very long. Like how we caught real estate a couple of years back, again, based on the concept of relative strength. And the beauty is not many textbooks on technical analysis, which were written in the 1970s and 80s and 90s, refer to this study. And today's students read those textbooks thinking that they have covered everything. But the truth is, it's not part of that curriculum. because this is a very new age tool. So you have to experience it, you have to use it. And I'm more than happy, to answer any questions that any of your viewers might have at a later date. They can send me data over mail and I can help you. So to answer your question, relative strength analysis is the way to correctly pick sectors and stocks.
So, since you have talked about it, I would like to also know what are the specific methodologies or tools for assessing relative strength, if you can let us know.
See, first things first, please do not look at 5-minute and 15-minute charts. I think I see a lot of students, I see a lot of people in the markets trying to do 1-minute charts, 15-minute charts, 30-minute charts, trying to make money on a daily basis. At the end of it, it's a zero-sum game. Even if you're very smart and you make 10 money for 10 months in a year with a certain strategy, the market will come and it will disrupt it in the next couple of months. I mean, it happened in COVID. People had great 5 years. And then in 2 months, it took away 5 years of returns. And this will keep happening. There will be a new COVID type of factor. I'm not saying that something like that, but such, out of the box developments will keep happening from time to time. So do not look at shorter term charts is my key message to your viewers. Look at daily and weekly charts. Think about the bigger picture, think about the medium term, long term, and think about playing bigger trends. Think about playing test cricket at the markets and not T20 on a day-to-day basis, because then you have a very greater chance to get out. So that's my key message, that if you look at daily charts, weekly charts, and if you use the concept of relative strength on that time frame, one more simple tool is, you want to know which stock is going to outperform the Nifty. You simply do a HDFC Bank divided by the Nifty, you get a ratio chart. You can get 50 such ratio charts because there are 50 stocks in the Nifty, right? And those 50 stocks in the Nifty, you assess that which are the top 5, 10 best ratio charts and accordingly invest. Believe me, it's the simplest way to do financial market analysis, because at the end of the day, price action discounts everything.
So, since we discussed about relative strength, we have audience who want to know what would be the suggested books to study more about relative strength. So, if you have some suggestions for them.
Yeah, that's a good question. Sadly enough, there are not many books on technical analysis on that. But there is one author, Mr. Martin Pring, who's written some amazing books on technical analysis and relative strength. So you could definitely follow his teachings, his learnings in the field of technical analysis. And secondly, if any of your viewers are interested in technical analysis, there are a lot of books prescribed by the CMT Association, which gives out the CMT degree. So those books are very, very useful to gain knowledge. So that's a set of about 6 to 8 books. You can take one book at a time. And also the teachings of, Mr. Martin Pring would be very useful.
Thank you. Thank you for that. Moving on to our next question. How to find stocks? How would you suggest we find stocks for swing trading? And what would be the key indicators and patterns technical analysts will look when identifying swing trading opportunities?
See, technical analysis has changed. It's evolved in the last 2 decades. When I got into the industry, we used to simply find a trend. We used to assess a pattern. We used to find a trend line breakout and we used to take a trade, and it used to work. But today you speak to anybody, on the street, there are 8 out of 10 trend lines which are actually failing. There are 7 or 8 patterns out of 10 which are failing because people are not understanding the psychology behind what they are doing. After all, every pattern is a fight between bull and bear, and a fight between greed and fear, and a fight between demand and supply. You have to really assess that fight between demand and supply. So I think these are some tools that we like to use, and I would definitely recommend your audience to go by that.
Gautam, as we speak, I can see in the Q&A section that people have posted so many questions stock specific. So they are very positive that we are going to get some answers with related to particular stock. Like one of the questions is, because we were talking about ICICI Bank versus HDFC in the current scenario. How would you advise on HDFC Bank, whether we need to wait or sell it or substitute it with any other script, if in case it is already in the portfolio?
SEBI compliance does not allow me to give me specific views on specific stocks, but I'll keep it very general, and I'll keep it more, to give you a perspective about things. I think banking is a space where you need to be invested. And within the banking space, I think the outperformers from our observations have been ICICI and SBI, and I've spoken about it multiple times on TV as well. Now, with HDFC Bank, I think the key message is that it's underperformed for 3 years, right? And it's not very richly valued, but it's very highly overowned. And in today's world, it is going to be very difficult to generate alpha from HDFC Bank. It will give you a peaceful night of sleep, but it might not give you supernormal returns, which a PNB has done, with a SBI has done, with some of these smaller PSU banks have done. So if you have to take the next 1.5 years, I do believe that some of these underperforming stocks will now start to perform. Why? Because the downside is limited. People have given up on them. Earnings are at pace. Earnings have been pretty good over the last few quarters. I think the market will realize it over the next 3 months, and then you will see a good uptake. So yes, at Goldilocks also we are looking at some of these underperformers. For example, an ITC did nothing for about 8 months. Great company fundamentally, looks like it is turning around, and therefore your audience can actually look at them.
Thank you. And so we already have answer, and I would request that whatever your queries are, keep pouring in. Less about stocks, more about economy, so that we will be able to answer. And whatever is not answered during the session, please feel free to reach out to us, and we will take it up later. Gautam, so we were discussing about swing trading, and you mentioned about the key indicators. Can you also help me with what would be the key risk management strategies, specifically tailored for swing trading?
Okay, so I missed one point on the key indicators when you asked me.
Yeah.
I think people should not look at a single study to arrive at a decision. I see a lot of youngsters doing that. They follow one pattern, one trend line, one indicator to take a judgment whether it's a good buy or sell. It's almost like when you go to a showroom to buy a car, you will ask that manager at least 15 questions, before you take the plunge to buy that car. So why not with a stock? Right? So use multiple studies together to arrive at a decision. Decide for yourself that these are the 7, 8, 10 studies which I'm going to use. And if 6 out of 10 are in favor, of the stock going higher, you take a trade. Please do not base your decision on one single study, which I think is a big mistake. And then you will give up on markets and you will give up on technical analysis. On the risk management point, there is just one tool in technical analysis which works like magic, and that is moving averages. It is a very age-old concept. For anybody who's learned technicals would know that you simply ride a trend with a Fibonacci number, with a 13 moving average or a 34 moving average, 55 moving average. Until that moving average level does not break, you stay committed in that stock. Believe me, there have been times in the last 2 years where you entered in early 21 and you got an exit only in 2024. This is the simplest concept of risk management. I know, you can complicate it, and I can give you some exotic formulas, which will sound very intelligent. But moving averages, believe me, is the best way to manage risk at the markets.
Noted. Thank you, Gautam. Moving on to my next question, which is a personal favorite. How to identify market psychology using technical research?
Yeah, so it's a great question. They used to say that when the panwala is talking about stocks, you should be very
Cautious.
cautious and uncomfortable. But the truth is, in the last 1 year, the panwala has been talking about stocks, and he's been
True.
right. Because if you thought that the panwala is talking about stocks and you were out, you would have missed a very big rally, right? So I think
Absolutely.
because liquidity was a factor which was never there 20 years back. Now the panwala and the rural population of India is doing SIPs. It could be 1,000 rupees a month, 500 rupees a month, but that's a huge revolution, right? But from a technical analysis perspective, we use something called market breadth. So recently, a month back, when the market was looking a little toppish at 22,800, we saw the number of stocks making 52-week highs while the Nifty was at a high. And we saw that stock participation was not there. So what we did, we put out a cautious stance, and then obviously the market fell about 1,000 points. We also see the number of stocks trading above the moving average. That number was also questionable 1 month back. And we also look at the advanced decline line. See, as they say, if the market is going up, you want momentum to be good. You want many stocks and sectors to go up. If the market just goes up based on 5 stocks, it is a psychology. that just five stocks are taking the market higher. So one way to understand psychology is the study of breadth. And you spoke about how to understand greed and fear. So, in COVID times, let me explain this because this is very important and it could be very useful for the audience. I use the NSE 500 index. On the NSE 500 index, the number of stocks which were trading above the 200-day moving average was zero. This had never happened in the history of of our markets. So when you had such a low reading, you knew that it cannot get worse. This is probably the most pessimistic scenario. In a normal scenario, the percentage of stocks trading above the 200 moving average is 20%, 30%. Right now, as we speak, is about 60%. So when such numbers come at very low levels, you know that there is a lot of pessimism and it cannot get worse. And that's when you take your contra decisions to invest, and that's how you make money.
Right. So Gautam, since we were talking about contra, and in fact, when you mentioned about the Panwala, that's absolutely true. In the past 1 year, 1.5 years, the market rally has been so broad-based that whatever you are entering in is also growing, whatever you are exiting is also growing. So it's almost like what do you exit from, what do you enter into? So, as you said, some contra calls that we need to take. Would like to understand your because you mentioned about your choices sectors that people should look to invest in. Would also like to know your perspective on some few other sectors which are also the talk of the town. Like, how do you see chemical sector for from the perspective of 1 to 2 year window? And I mean, some time back, you have seen it as making a bottom. So what is your perspective on the chemical sector?
The chemical sector gave multi-bagger returns in 2020, 2021. I remember speaking to a lot of people on the street who said that there is a big opportunity coming. And there were so many stocks that moved up 2x, 5x, 10x, 20x in that 2 year period. Thereafter, people felt that this is going to go on forever. Did not happen because all the positives were factored in. All the positives that came out of China was factored in. And it got into a correction stroke consolidation for 2.5 years. Now, as we see in the last 4 months, the turnaround is gradually happening. And even the fundamentals are picking up. The management commentary in their con calls is getting better, which my analyst does. And he keeps giving me the feedback that the charts and the fundamentals are in favor. So the commentary is good. The charts are getting better on a standalone basis. And the ratio charts of chemicals divided by the Nifty, the point which I highlighted earlier, that's getting better after almost 3 years. So I think the risk reward is very good, but you just need to be a little stock specific. I mean, look at what happened to SRF after the results. It can happen. On the other hand, if you look at a Deepak Nitrate or an Aarti Industries, continues to do very, very well. So I like it as a basket, but just be a little stock specific there and only buy stocks which are showing good relative strength.
So, but then in the last couple of weeks, there has been weakness in the chemical sector in totality. So, do you see more pain before it picks up from here?
See, as I said, I'm not concerned about day to day. I think if I have to look at the next 6 to 12 months, I think chemicals is an opportunity. And because of the recent dip on account of the result season, obviously, because of which you are seeing some volatility and weakness, I think this is a buying opportunity. I think the men have been separated from the boys in the chemical space. I gave out a couple of names, and I think if you study their fundamentals and the charts, you will believe that they will do well. So this near-term weakness is an opportunity.
All right, thank you. Since we were on sectors, I'll like to take up one question from the Q&A section, which is also about the sector. But this particular talks about the hydrogen industry, which is a revolutionary technology. So what's your view on hydrogen industry?
See, I'm a technical analyst, so I'm not correct place to give you a fundamental thesis of what it could do in the future. I think I'll have to study, deep dive, tell my analyst, and maybe come back. I keep hearing about it, but these are very complex terms, and these are very complex factors that we need to assess. But speaking about hydrogen, the bigger theme that's played out in the last 2 years is EV. I think EV as a theme really worked well. And I think that's probably the theme of the next 5 to 10 years. So I keep telling this to many of my clients that over the next decade, you need to be a buyer in all EV proxy stocks. I know some people say that it's already in the price, but I think you are already seeing just like liquidity was a revolution, this EV car as a concept is a revolution. And some of these new age concepts, so EV as a theme, financial services as a theme, I mean, look at CDSL, look at CAMS, look at wealth management companies, broking companies. They once done so well. So many of these new age businesses, Zomato has been a personal favorite. I've recommended it on multiple platforms in the past. I don't think an India can survive without an Zomato. We're just used to the way we operate. So these are some of the companies where you have visibility for the next 5 to 10 years and you just stay invested.
Right, and because I mean we can choose about the sectors, because there are multiple sectors and India is going to be a 5 trillion economy. Most of the sectors will flourish. Would like to know your view on the solar industry and solar sector as well. Like EV, I am listening a lot about the energy as an opportunity has picked up really great in the recent time. So if you can throw some light on the solar sector, solar industry, energy as a sector.
Yeah, absolutely. I think that also is the future. And I think, I always say that the market is the best judge. And if you look at all the solar proxy stocks or the energy or the power proxy stocks, they have been some of the best performers. I remember Tata Power used to be a 50 rupee stock. It's become a five bagger. I remember GSW Energy having, discussed about it at 150 rupees. Today it is at 600 rupees. So I think solar and power and EV, these are mega trends. These are mega themes. Whenever you get a market correction, you just stop up on them and just keep a track on what the management is saying on the con call. I think that's very important because sometimes we drown in these themes thinking that okay, this is here to stay forever. We live in a world of disruption. You watch them, you monitor them, and in the con calls, you just follow them.
Right. But Gautam, what I'm realizing is in our entire conversation of all the sectors that you are positive on and the sectors that we are somewhere positive on, I see IT missing. So, what is your take on IT as a sector? And do you think that it is a good time to start the fresh investments? Because I think a year back, the discussion was that Europe is not picking up, and that's why services industry is not picking up. But now we see the revivals happening across the globe. So what's your take on fresh investments in IT sector?
See, I think the IT sector has lost its way in some sense because in the last 4 months, while the markets where the Nifty was range bound, IT was actually in a downtrend. And let's not forget the mid cap IT stocks are very richly valued. People have put out the Excel sheet numbers of the next 5 to 7 years, which I don't agree to because I think the world changes every year. It's changing every 6 months, in fact, right? So mid cap IT is definitely an avoid because I think all the positives are in the price. They have to justify where they are right now, right? So forget about the future. But large cap IT is definitely an opportunity. And in the large cap IT, I think the top names, I mean, we like TCS, we like HCL Tech, and we like Tech Mahindra. I think they could be an opportunity over the next 12 to 18 months. But will they generate alpha to your portfolio? I think the answer is no. And secondly, there is this big debate as to how artificial intelligence is going to change this industry in India and world over. I think that's a key debate, and many of these companies can actually get impacted because of that. So do remember this key risk. If you're thinking 3 to 5 years, you have to understand and assess this key risk. And because of that, maybe IT might not be the best performer because they're all richly valued at these levels.
Thank you for that insight, Gautam, because one key sector where when we look at services, but at the same time, whether it's a good time to enter, thank you for the insight for the same. So now we had been slightly away from our questions, which were particularly pertaining to technical analysis, because would love to know something more on that. Can you help all of us understand the role of derivative data in identifying the market trend?
See, I think derivatives data is for me a double-edged sword. You want to present a bullish view, you can present it based on the data. You want to present a bearish view, you can present the data. One great example, in the last 2 days, everybody is saying that FI data is on the short side is extremely high. FIs have taken very large short bets in the market. So if somebody wants to present a negative view, you can say that FIs have taken very large, short bets on derivatives. On the other hand, please understand the logic. These very FIs have taken hedges in the system to protect their existing long positions. So when you think from that perspective, you feel that they have just bought insurance because of the important event that is ahead of us in the next 2 to 3 weeks. So I keep telling my analysts, please do not spend so much time on derivatives data. Yes, there will be smart money. There are people who are smart, they enter early. And if you think you're going to find them on the derivatives data, the answer is no. Once in a while you can, but the best way to understand smart money is the price action. So study the price action more than the derivatives data and don't spend your time. You'll get confused all the time.
But again, if still we ask about some specific derivative instruments or metrics that are particularly useful for this kind of trend analysis, what would be your suggestions?
See, again, you can talk about put writing, where the put writing is, how is the call put data, where is the large open interest. These are the very basic things. If an important company like Reliance is coming up with results, has the OI open interest gone up or gone down? Where is the maximum put selling bets, which I think sometimes is very important because it gives us a sense as to where the real commitment of money is. And based on the commitment of money, the market will react accordingly. And if there are very large put writing bets or call writing bets, you generally see much larger trends and larger moves at the markets, right? And given the current situation also, given the large uh, derivative bets that we are seeing, I'm pretty certain that between now and June 30th, you are going to see a very large move on the market. Can it be on the downside? Unlikely, more likely on the upside.
So, can you suggest any specific technical technique where we can hedge our portfolios for specific events like upcoming elections?
Well, I think there are two ways to hedge. One is to go low beta. You've been trading or investing into DLF all along. Maybe right now go into ITC, right? So if the markets were to fall a lot more, if the markets were to fall, then maybe the low beta stance can actually help you in the long term. So that's one way to do it. The other way is you ask me what is the trading strategy. For me, a moving average crossover is probably the best strategy technical analysis has ever seen. Nobody discusses it so much because it's as simple as it can get. You can just pick up a book on technical analysis, understand the concept of moving average crossover. I mean, it takes an hour to really explain it. So this is not the session for that. But I'm just leaving your audience with this view that if you can study this concept, believe me, with very little work, you can garner great returns at the markets.
Audience must have noted this as well. Moving on to my next question, what do you suggest would be some specific indicators to identify the market trends? The most widely used trend following technical indicators for technical analysis, and how are these indicators? How effective are these indicators combined for a trend confirmation?
See, in anything that you do, I mean, technical analysis is a creative job. In anything that you do, you have to keep the basics important. You've heard of when you watch cricket IPL, you've heard a lot of competitors say, and a lot of cricketers say, stick to the basics, right? Markets are just like that. So in technical analysis, the basics is Dow theory, which is if a stock is making higher tops and higher bottoms, it's in an uptrend. If it's making lower tops and lower bottoms in a downtrend, as simple as that. If you simply took a trade based on this one indicator or setup, you will do well for yourself. And believe me, just go back test it over the last 10 years of data, and you will see that the triggers, the signals might have come a little late, but when they come, they are sure signals. You can actually allocate large amount of capital based on these signals. So Dow theory is right up there. Moving averages, a stock has to trade above the moving averages for you to be a buyer or for you to stay invested. Pattern analysis can be done. And indicator analysis, it sounds very exotic, but it doesn't really help so much because it confuses more and gives you much less clarity than some of the other studies. So the first three, which I pointed out, I think is the key message to your viewers.
Thank you for clearing that out. My next discussion would be on one of the initial discussions that we had, that apart from the three major sectors that you were positive on, you talked about commodities and gold and silver, precious metals, as one of the key categories to look at for investment, and not tactical as a strategic call. So, can this ongoing rally in precious metals affect the stock market? And I mean, what is the potential linkage between these precious metal prices and the stock market movement? As you talked about, if in case there will be a rate reversal, we see these precious metals doing better. So, can you please help throw some light on the same?
See, that's a good question because it's a question out of the textbooks. In the past, we have always heard that If the FD rates go higher in the economy, people will deploy more capital in debt and FDs and not much in equities. Traditional thought process. If you get an FD at 9%, for example, which you do get in some small banks, why would you want to risk your capital in the equity markets? Fair question, right? And there have been times in the past where you've had such high FD returns. Because of that, equity markets were down. Similarly, if gold and silver are doing very well, does it mean that people are going to stay away from equity markets? I think the answer is no. Because we are seeing a revolution in disciplined investing. Investing was always a culture. Now it's disciplined investing. And because of that, it doesn't matter if the FD rates are going to be at 7, 8, or 9%, or if gold and silver does well, because that SIP of that common man, or anybody is going to continue. So I think that's really changed the game. And I don't think these inter-market dynamics is not going to impact the market so much. And any which way you are in an environment where rates are likely to come down. So if from the current 7, 8%, if the FDs, if the debt funds start giving you say 4, 5, 5.5%, you'll have more money flowing into equities.
Absolutely correct, Mr. Shah. And of course, as we discuss in the nutshell about the Indian markets and the growth potential markets have, there are definitely some risk management tactics that we need to have handy with us. So, can you help us understand some general principles of risk management in beat trading, beat investing? What, as per you, should be the basic risk management principles?
See, there is one fundamental risk management and then there is one technical risk management. The fundamental risk management is stick to quality, right? Bet on the big boys. It could be in the mid caps, it could be in the small caps, it could be in the large caps. And mind you, it's a very interesting line here which I'm putting out. Bet on the big boys in the small caps, right? Because if you look at the top 100 small cap companies or the top 100 mid cap companies, that's where the biggest opportunity is. Because as we speak, 9,000 crores of liquidity, sticky liquidity, is going into those companies and businesses consistently every month. So in the last bull market, 2003, 2007, every time the FIs left the country thinking that, okay, we will come back later when the momentum picks up, the markets used to fall. So that's why I think risk management, stick to quality. That's the key, because anything that is substandard will get punished very fast in a difficult environment. And we have seen it in the last 6 months. I remember a month and a half back, the Nifty was down 5%, but many portfolios were down 30%. Why? Because they were in substandard stocks, which were just rumor driven, story driven, theme driven, and all kinds of things. So that's fundamental risk management. The technical risk management is, for example, in a very simple way, only stay in stocks which are trading above the 200 moving average. Any stock in your portfolio, if it is below the 200 moving average, it has to be out. You can also have a strict percentage stop on every trade. So a lot of people ask me that what is a good percentage? Don't keep 2, 3%, 4% as a stop loss. If you're taking a trade, for example, tell yourself, I will not take more than 7% loss in this trading idea that I'm in. Clear objective risk management. For investors, you might say 7% is too less. Fair point. You need some space for volatility. An investor can say that I'm going to keep a 15% stop loss, that if I lose 15, but if I gain, I want 30 plus, plus, plus. Again, a very objective risk management. And if the stock has gone 15% against you, you realize that maybe my reading has been wrong because the market does not coincide with my reading. And therefore, I will now look at something else.
A very useful insight. And you mentioned about how markets have been in the last 6 months and 1.5 months back. I think it was March 15 when the markets were they corrected way too much. But Gautam, if we particularly talk about what would be some risk management techniques, because currently we are in a very volatile phase in the last 6 months, last quarter particularly. So what would be few risk management techniques in such volatile market conditions and specific trading strategies that you can share with us that we should follow in order to be profitable there?
To be very honest, the market is not volatile. Because if in the last 4 months we traded within 1,000 point band, what is 1,000 points? It's less than 5%. I mean, if you compare that with the past, the 2003, 2000 bull market, on a routine basis, we used to see 10, 15, 17% corrections. Since the time COVID hit us, if you look at the last 4 years, the largest correction was about 15%. In 4 years, the largest correction is about 15, 17%, which happened. So I think the market has become such that large caps and the indices might not give you super normal returns anymore. So be prepared for that, and therefore, don't overcommit yourself. But the real return and the money is being made in mid caps and small caps, which are top quality. So if you can invest in those names with strict risk management, the two concepts which I mentioned, fundamental and technical, I think you'll be good to go for the next couple of years.
Thank you. With that, we come to an end of all the questions that I personally had for the audience. At the same time, we have some questions which have poured in. So we quickly look at it, look at few of the questions due to the paucity of time. One such question is, while we were discussing about the rate cuts that are most probable to happen towards the end of the year, starting with the US, what will be the beneficial sectors during the rate cut for Indian markets?
See, I think number one, let's cross the bridge when it comes, because I think that the reason for that is just, in the past, people said that because there is a rate cut, these sectors will be beneficiaries. I mean, that's a very fundamental concept. But today, every single sector, for example, banking has four other factors to look at along with rate cut in the economy, right? So I don't think you can over prepare yourself well in advance. Right now we're talking about elections. Let the elections get over. Let the inflation numbers of the next couple of months come by. Let the earnings season get over. We'll talk about it closer to July. And that time we will see the scenario. And, knowing the benefits of these rate sensitive sectors, we all know, which are the ones. The question is, will other factors impact them or not? And you factor that in and then take a call.
Absolutely correct. My next question is that during our discussion, we particularly talked about general election results will be out in the next couple of weeks. So it is something that the market has already discounted. So Indian elections may be maybe a non-event as of now. But what about US elections, since it is one of the major markets? What's your outlook on this?
See, yeah, I think in Indian markets, it looks like a non-event, which is what everybody feels based on talking to friends, talking to family, and getting a pulse, right? We just feel it. But I just realized that the market is the best judge. It tells you, what it feels about the event, and it reacts accordingly well before the event. So in India, we should be okay. But US market elections can be a very big catalyst because that's also being fiercely fought, and you have all kinds of people right at the top trying to do all kinds of things. Some things might be a little crazy as well. Given the battle with China and the battle with Russia and many other countries, there are a lot of dynamics at play. So I think, as you rightly asked me, more than India, I'll be closely watching what happens in the US because that can have uh, a lasting impact on the global dynamics.
Gautam, my next question is by Mr. Anmol. He says that while we were discussing about your range of Nifty between 21,500 to 21,800, that's your comfortable level. But what are the chances that these level will get breached, and what will happen if in case these level gets breached?
So 21,500, 21,800 for a trader is a very important support level. And as a technician, you can't be sitting on the fence. Sadly, in today's world, and in, when pretty much everybody is a technical analyst, people talk iske niche ye hoga, uske upar wo hoga, right? You can talk both ways very easily. The way we do our technical analysis, we stick our neck out and say it's unlikely that those numbers will break. But let me give you an investor support as well. The day the assembly election results were announced in December, the low of the Nifty was 20,500. And it was in that month that we realized that, okay, we have some idea what could happen in the first week of June. So for me, as a trader and as an investor, till the market is above 20,500, I think all is well. Don't look at these day-to-day moves because that's the number which I think is the base and the foundation to the market. If that number breaks, I would be very, very concerned. But till that number does not break, and I don't think it's going to break in the next few months, or maybe for the rest of the year, then I think we are safe.
Thank you for that. Also, Gautam, we have another question that talks about defense sector. So now defense sector is on lifetime high. So do you see that this sector will still do better? You see some juice in this sector?
See, defense is a theme which is here to stay, no doubt about it, because government's commitment towards defense is only going to get bigger and bigger over a period of time. So I think that continues to be absolutely strong. And but a lot of stocks are quite overbought at this point of time. So I don't think you should be making any serious commitments in defense at this point of time. There are better sectors in the market to commit into. Defense and railway to some extent is a little overdone, so one should be a little careful.
Thank you. My next question would be about the semiconductor industry. What's your view on semiconductor industry, considering investment in global and technology are, I mean, we are having pool of opportunities there. So what's your view on semiconductor as a sector?
Well, honestly, I haven't studied this space deeply enough to be giving a call on this. But having said that, I think this is a very stock specific space. I think the industry has made maybe 3 or 4 big names that could be beneficiaries, but I don't have a detailed view. And since I cannot get into stocks, I don't want to give out names.
So, with that, Gautam, actually, my last question was supposed to be a very interesting one for our audience, because I would have asked you a stock that you would particularly feel that would be your the key takeaway, one more key takeaway for the audience. But given that I mean, we cannot discuss that. So, what would be that one sector where you feel that this is that sector at whatever levels we are? This is a sector, this one particular sector where we see whatever, as you mentioned, that few sectors like semiconductors are very stock specific. But if you can help us know that one sector where people can just get in and they could have some really nice benefit going forward.
See, I think I've just believed that post-COVID, people have realized that they need to live their lives better. We always say in Indian culture that save for the future, save for the future, but you never know when you have such events. So live for today, right? And spend for today. So keeping that theme in mind, I think hotels and travel and leisure in general is a very big theme which is here to stay for the next 10 to 15 years at least. In that context, a company like Indian Hotels, and I've spoken about it multiple times on TV, so I think it's public on public domain. I've been a big fan of the Taj brand. We recommended it as our Diwali idea a couple of years back, still going very strong. And it's had such high entry barriers, great business coming from the Tatas, great brand. It getting sold into at all kinds of prices. I'm traveling to Bombay next week and I'm staying at the Taj Land's End, and I know the kind of prices that I'm paying, and I'm still paying for it. So the key message is look at what Indigo has done, look at what Indian Hotels has done, right? So some of these businesses where that they have very high entry barriers and is a story for the next 10 years, I think you invest in them on every day.
Thank you. That's very kind that we discussed the stock towards the end of the session. Due to paucity of time, attendees, we would not be able to take up other questions, but please feel free to drop in your questions on our email ID, and we would be very much looking forward to answer that. With that, thank you so much, Mr. Shah, for a very interesting and insightful session. Always a pleasure interacting with experts. Thank you all the attendees. StreetXperts will be back with more such interesting discussions. In case of any questions which remained unanswered, do reach out to us through your respective RMs or through your website www.mastertrust.co.in. With that, we would like to conclude this webcast. Thank you all for tuning in. Thank you, Gautam.
Thank you, ma'am.